Hello, everyone. Welcome to our group presentation for BUS 608 International Financial Management. Our presentation is about the global case analysis and it will be presented by me, Payal Kapoor, my partner Shavi Rana, Sharing Thaldan, Dipankar Rangna, and Geeta Thilanki. I'm going to start the presentation with the introduction. In introduction, we are going to discuss about the case 1 that examines the example of currency swaps in practice that have been beneficial for the various parties concerned, which provide insight into the significant advantage of the financial activity. This risk associated with the financing of trade abroad is explained in case 2. The third case focuses on the factor that affects export and a view to exporting shoes from North Carolina. It also looks at the decision-making process in establishing a manufacturing plant in Ireland. The case 1 will now be discussed by my partner Shavi Rana.
Hi, this is Chavi. I'm going to talk about Centralia's corporation's currency swap. Centralia, a corporation, has a competitive advantage in the US to lend money at an interest rate of 8%. However, the company is not well known in the Spanish or international bond markets, so it would have to pay 7% per annum to borrow euros. Spanish MNC have a competitive advantage and can borrow euros at 6%. However, it must pay a 9% fixed rate in the United States to borrow dollars. Both firms have account receivables and payable and want to borrow the same amount of 2.9 million to finance an 8-year project in the other nation at the estimated exchange rate of dollars 1.33 for each euro. Uh, while Spanish MNCs have a competitive advantage when borrowing in euros, Centralia has that benefit while borrowing in dollars. Both companies should engage in a currency swap to reduce costs and mitigate long term interest rate and foreign exchange rate risk. The market value of the dollar debt is the present value of a 7-year annuity of $232,000 and a lump sum of 2.9 million discounted by 6%. This present value of $32,023,778. Similar to this, the present value of the remaining 7-year annuity of 130,000 plus a lump sum of uh, 2,180,451 euros discounted at 5.5% make up the market value of the euro debt. This present value is 2,242,408 euros. The swap dollars value is 231,733 dollars. The swap's euros value is minus 173,670,400 euros. Currency swap that will benefit each counterparty. That is, that Spanish MNC should issue 2 mil of fixed 6% in fixed interest debt, and Centralia had to issue 2.9 million of fixed rate 8% debt due to the relative comparative advantage of each counterparty in their home capitals. In a year, they'll exchange the principal amounts. The contractual exchange rate for the initial exchange is either $1.33 or €1. The counter pillars parties will swap the debt service on a yearly basis, with the Spanish MNC paying Centralia 232 thousand and Centralia paying the Spanish MNC 130 thousand 827 euros. The first seven early yearly debt services exchanges contractual exchange rate is 232 $100,000 and 130 €1,827 or $1.77 or either $1 or euros. The principal sums and the final debt service payments will be exchanged once again by the Centralia and the Spanish MNC on the due date. The contractual exchange rate of the final currency exchange is 3,122,000 dollars and 2,311 thousand 278 equals to 2.9 million plus 232,000 $100, uh, or we can say 1.355 dollars, or either €1. Thank you.
Hello everyone, myself Dipankar and I will be presenting Case 2 Financing Trade. It is appropriate to compute swishing's profit in terms of present value. Swishing will get £376,000 today by discounting the banker's acceptance. The present value of £400,000 to be received in 120 days, discounting at swishing WACC at 18% is 3 3,077,358.49, and there is 1358.49 mismatch. Waiting 120 days to acceptance face value would result in gain for swishing of £1358.49 in terms of present value of cash. In transaction, the swishing assumed risk of foreign exchange transactions, that is, the risk that is value of pound sterling to be received from export would be less than value of dollar when it received. Part of risk is due to the fact that swisher has to wait for the pound to be exchanged for dollars. Swishing will instantly receive money at the current exchange rate if discount the banker's acceptance at the moment of sale. Swisher is assuming an additional risk of a failing exchange rate during the period from sale to collection if swishing has waited until 120 days before receiving pounds or sterling. If the pound buys more than 120 days worth of dollars, swishing would make profits. Thank you. And next slide will be done by my colleague.
For case study 3, we need to find out the factors that swishing should consider in deciding whether to continue to export from North Carolina or manufacture them in Ireland. The following factors need to be considered for exporting shoes from North Carolina. Swishing should compare the cost of labor, materials, and transportation. They should take account of the import duties paid by it for its shoes that are exported to another country, that is England. They should consider the exchange rate of United States dollar to the currency of the country they are exporting to. See how much shipping and insurance is involved. They should also consider the time needed to make and ship the shoes. Okay, now the following are the factors that needs to be considered to commence a manufacturing plant in Ireland. Swishing should consider Ireland and the US corporate income tax rates. Current and potential changes in shipping costs for the coming years must be considered as well. Also, the expected production volumes in Ireland compared to the plant manufacturing capacity of the new plant there should be considered. The cost of footwear production in Ireland will be determined by the volume of production foreseen in the plant and by the percentage of capacity expected to be used in the near future. Furthermore, it is crucial to consider the cost of labor and material in Ireland in comparison to North Carolina. It is important to consider the availability of labor and the level of training that is accessible to the potential workers. The potential for theft of valuable proprietary technology must be considered and well guarded too. Investing in Ireland for the British market may carry a potential a political risk in case political terrorism of the sort that exists in Northern Ireland and anti-British sentiments there extend to the Republic of Ireland. We never know. In a nutshell, Swishing Shoe Company should conduct a cost-benefit analysis and assess the pros and cons of each option to make an informed decision that maximizes the profit and aligns with their strategic goals.
Hello everyone, my name is Geeta and I'll be discussing the pros of currency hedging. The first one is risk management. Currency hedging can help firms and investors by reducing their exposure to currency fluctuations. This makes it easy to manage financial risks and prevent large losses in case of adverse currency movements. The second one is stability. By hedging against currency fluctuations, companies and investors can reduce their exposure to foreign exchange volatility. So it is easy to manage financial risk and prevent large losses in case of currency fluctuations. Third one is flexibility. Currency hedging allows investors and businesses to lock in exchange rates and adjust their currency exposure over time. This will give them a greater degree of flexibility and control over their financial position. Moving on to the next slide. Cons of currency hedging. The first one is cost. Transaction costs, fees, and bid-ask spreads are frequently associated with hedging methods, and they can have an impact on the profitability of investments as well as investment returns. Short-term focus. Some hedge strategies focus on the short run and do not offer sufficient protection in case of currency movements over a longer period. Inefficient market. The currency market is often ineffective and can also be expensive to hedge. Consequently, it is difficult to calculate the cost of hedging and make informed decisions. Moving on to the next slide. Pros of natural hedging. A risk management strategy that helps managers to mitigate downside risks. It allows company to cope with difficult market conditions, protect traders from volatility in price and interest rates, inflation and currency movements. It will save a lot of time because the company doesn't have to deal with fluctuations on a daily basis. Moving on to the next slide. Cons of natural hedging. Implementing natural hedging, it involves extra costs such as purchase of assets to protect against rivals. And although they can lower the risk exposure, there may be trade-off between risks and rewards that result in a reduction in overall profitability. This strategy may be less effective at completely minimizing risk than financial hedging strategies because it depends on the inherent link between assets and circumstances.
Thank you everyone for explaining all your slides in brief and explaining all the cases in a very good manner. Now we are going to talk about the conclusion. So in conclusion, we are going to state that these cases underline the important role of finance strategies and risk management in international trade. The potential benefit of exploiting domestic market advantages were seen in central corporation currency swap. The importance of timing in foreign exchange transaction has been underlined by Swishing's risk management approach, and currency hedging has become a key instrument to mitigate currency fluctuation was the outcome that we all generated through the brief research we have done for all the cases. Thank you everyone for listening so patiently and be a part of our presentation. If you guys have any questions or if you have any views regarding our presentation, you are very welcome to send us an email or ask us through. Thank you.